Welcome, small apartment investors, to the presentation on tax strategies in apartment investing. Welcome! Today we're focusing on tax strategies in apartment investing, a critical area that can greatly impact your overall investment profitability. Understanding the tax implications of apartment investments and leveraging available tax strategies enables investors to optimize after-tax returns and retain more of their income. By planning proactively, you can reduce your tax liability, enhance cash flow, and ultimately maximize your investment returns. Key concepts in tax strategies for apartment investing. Understanding tax implications in apartment investing. Rental income taxation. Rental income is treated as ordinary income, meaning it's subject to standard income tax rates based on your tax bracket. Rental expenses, however, can be deducted from this income, reducing taxable income. Depreciation deductions. Depreciation is a non-cash deduction that allows investors to recover the cost of the property over time. For residential properties, the IRS allows a depreciation period of 27.5 years, which can significantly reduce taxable income on paper, even if cash flow remains positive. Capital gains tax. When an investment property is sold, any appreciation in value may be subject to capital gains tax. Long-term gains, meaning property held for more than a year, are taxed at lower rates than ordinary income, which benefits investors upon selling their property. Passive activity rules. Rental income is typically classified as passive income, and passive activity rules limit the ability to offset other income with rental losses. Understanding these rules is crucial for minimizing tax liability effectively. Impact of tax rates and brackets. Tax liability is influenced by your total taxable income and applicable tax bracket. Changes in tax laws or rates can affect the profitability of your investment, making it essential to stay informed and adjust strategies accordingly. For example, rental income is considered ordinary income, subject to income tax rates. If your rental income places you in the 24% tax bracket, you would pay 24% on this income after deducting eligible expenses. Years of ownership, enhancing cash flow. Example: calculating tax liability on rental income. Let's look at a hypothetical scenario. Suppose an investor owns a 10-unit apartment complex that generates $100,000 in rental income annually. The investor has $40,000 in deductible expenses, bringing the net rental income to $60,000. In the 24% tax bracket, the investor would calculate tax liability as follows. Calculate taxable rental income. Taxable rental income equals total rental income minus deductible expenses, which is $100,000 minus $40,000, equaling $60,000. Calculate tax liability. Tax liability equals taxable rental income times tax rate, which is $60,000 times 0.24, equaling $14,400. In this scenario, the investor's tax liability on rental income would be $14,400, assuming no additional deductions or credits.